Hi, hi guys. Welcome to Accounting with Naomi. It is another session, it's another revision. Basically we are continuing with our part 2. Um Hi everyone. Hope you are all here. Hello, hello. I see people are greeting. I see greetings. I see greetings. Hi, 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 hi. Welcome to our revision. Welcome to our revision class. Welcome. All right. Hello. Please share the links. Please like the video. Let's start liking the video already before we can start. Guys, I apologize about time. I was having serious network issues and I was struggling to actually go live. That is why we are starting a little bit late as in comparison to the time that was discussed. So apologies for the time. Please like the video and share the links to every groups that you're coming from. Share the links. Let everybody come in so we can start together. Let's all come in. If you haven't liked the video yet, keep liking. Share the links, guys. Share the links. Share the links. I see others are not here yet. Share the links. Share the links. Share the links. Welcome, guys. Welcome. Hello, everyone. All right, guys. So, remember we started with our revision already on Saturday, and Saturday we did most of it. We were 5 hours live, guys, like straight, 5 hours live. I really hope it was helpful. Yes, I really hope the revision was helpful, and I hope you have worked through the question because it doesn't help for me to just do it and you not to work on it. For you to actually understand, for you to do well in accounting, you must always go back and do the things again. Okay, so you have to go back to the question and redo the question on your own. Try it and then see where you have failed, and then get your get your questions down. That's how we do it. And once you get your questions down, then you begin to work on your questions, and everything else is just perfect. Okay, all right. All right, guys. I'm seeing the likes are not really improving. Are we liking the video? Let's share the links. Let's share the links. Let's share the links. I'm gonna start in about 5 minutes, but before we start, I want us to just talk. Again, I'm insisting on your mental state, guys. Your mental state is super important, né? So your mental state is super important. I'm insisting that you look at this your state of mind. How are you? How are you? Guys, it's been exam. One paper after another, one paper after another. You're writing almost all the time, and there's no resting time. There's just no time to, to just relax. There's just no time, and you are constantly stressing. Your stress level is like very high at this point in time. So how are you? How are you, guys? How are you doing? How is it going? How is it going? How are you doing? Are you guys fine? All right. And I want to insist that you guys need to be okay. You need to accept things the way they are. The best you can give is right now. So right now you're going to study and prepare yourself. All right now, well, that's what you're going to do now. But later on, as when you're writing, whatever happens you gotta go there and know that whatever happens. I give it my best. Okay, please be careful, guys. Really care about you. A lot of students are dying nowadays. We're hearing people are dying. My God, this is a serious this is a serious situation. Like, people are dying after writing. This qualification, guys, comes with a lot of stress. It comes with a lot, I promise you guys, a lot of stress. So please, I am really begging, guys, take accept matters, accept things. You have done your best, you have studied, you have prepared, and if it doesn't go your way, then it's okay. You have given it your best. Okay, so please be fine. We don't want to hear any more stories of people, fainting after paper, people dying and all that. Please, you have to understand the world out there. It's stressful. It's not doesn't end here. After your studies, when you go out there, it's gonna be stressful as well. Guys, like, yo, out there, if you want to do CTA is going to be more stressful, like way more stressful. And when you get to work, guys, articles are stressful as well. So you just have to know how to manage your stress level. It's very important that you manage. Again, you're writing an exam. If you go there with stress and panic, you may just forget everything. I spoke about brain freeze the last time. I'm saying it again. Guys, you may just forget. You may just forget everything. So please, 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 I'm begging that you really stay calm, work on your stress level, right? Is it meditation that works for you? Is it gymming that works for you? Is it running that works for you? What works for you? Please stick to it, all right? Whatever works for you, stick to it, all right? And do it, okay? And just be calm and just give it your best. Be confident, trust yourself. Remember, studying is a psychological thing. Be confident and give it your best. Okay, guys. Right, with all that being said, I think we have said enough, guys. I also gave you guys study tips. At this point in time, if you are joining here and you have not like studied properly and you feel like, should I write? Should I not? Should I write? Should I not? I heard that the results are coming out tomorrow. This will then decide if you're gonna write or not. I just want to tell you, if you are right now and you feel like you have not studied enough and you are here, this is your strategy. This is the only thing you're gonna do. Okay, right now you're only gonna do assessment 5 2024, which is the final the exam that you wrote. Yeah, that assessment 5, that's the only, you do assessment 5. Then you go to 2023 papers, you will do the assessment 10, which we're doing now, and assessment 9. All right, so it's assessment 9, assessment 10 of 2023, and then now you're going to do assessment 5, which was the exam you previously wrote. Those 3 papers are the only thing you're doing right now. If you know yourself and you know you have not really given it your best, you have not really studied, just master those 3. Master those 3. All right, UNISA normally provides memos. Just go and get those memos. Do the question. Don't study question memo like guys. No, if you are studying like that, my god, you're not gonna get anything. You'd actually get the confidence thinking that you actually did well what you did it. Yeah? So please, guys, if that's your study method, don't ever study question memo. Question memo. Question memo. You would actually deceive yourself and think that you have understood when you haven't. So what you do is you redo the question. You do the question again. And once you have done the question, then you check the memorandum and you mark yourself. Then you pick up your mistake. Then you would understand, oh, this is what I did wrong. Oh, I should have done it this way and not this way. This is what they were actually wanting and not that. Do you understand? So guys, that is how it is. So don't use the memorandum to study the solution. Do the question and mark yourself. That's how you're going to pass. Okay, so that's the advice I wanted to give to us. If you have just joined, please like the video and share the link. Share the link to everybody you know. Share the links to the groups. Share the links around, guys. Share the links. Yes, share the links. Share the links. We're about to start. Share the links. All right, like the video. All right, so like I was saying, it's those 3. It's those 3 and nothing else. This is not the time to go and read. All right, you may just, when you start to read, you may just understand you don't know so much, and then you may just lose confidence. The number one thing is that we are keeping our confidence, guys. We are keeping our confidence. We are keeping our confidence, because that's the only thing that's going to help us to do well in this exam. If we panic, if we stress, if we feel like, no, I'm not ready, no, I didn't study enough, and all those things, when you begin to judge yourself like that, it's just going to affect the results, and that's not what we want. We want to pass. We want to pass. Okay, we want to pass. So it's confidence that we need. Those 3, that's it. No reading, no trying anything else. It's those 3 that we're doing until we actually conquer this exam. Okay, guys, remember, for those of you going for CTA, I would advise you that you don't study only for the exam. Please don't just study to pass and forget. That does not work. Accounting is a build-up. We're building up, and most of the things you're doing in 3rd year will just be what you're doing in CTA. The only difference is that the leveling of the question, the standard of the question is going to be much higher, much harder than it was in 3rd year, but it is the same content, it's the same thing, it's the same topics that you're going to do in your CTA. So please, don't study to forget. Don't study for now. Don't study for the exam only. Okay, please don't study to forget. All right, guys. So let's get going. Let's get going. I hope you are fine. Let's continue with our revision where we had stopped. We have done most of them. Most of the questions were done, and it was just the last few questions that we had to do on groups, which we're gonna finish up today. Once we finish, we're done with the class. Remember, this was today. It's supposed to be a little bit shorter. It's not going to be a 5 hour like we did on Saturday. That's what I'm saying. Most of the work was done on Saturday. Okay, so I greet you all and thank you guys so much for joining the revision. And please do talk about the channel, guys. Let's help grow this channel. Let's get more people into this channel so we can give more content like this. I know it's not going to be every day that I'm going to do this because I have a college that I'm running, a tutorial center, tutorial college, Eureka Tutoring. Yes, if you need classes on your accounting modules, right, please contact us. I'm gonna put our contact. I think I'll put it at the end of the video, or I'll put it on the description. I'll put our contact. If you need classes, please do contact us, Eureka Tutoring. All right, so if you want more of this kind of content, please, you need to share the links around. We need more people, more subscribers, more views, and things like that, so we can be giving also out classes like this. All right, guys, so with that being said, let us get going. Let's get going, guys. Let's start. So I'm gonna put my video off. And so that we can get to more serious business. I think I said that on Saturday. So let's get to more serious business. I'm gonna put the video off, and then we're going to go to our question. Okay, so let us go. Right, like I was saying, if you have just joined, please do like the video before we continue. Make sure we are maximizing the likes, maximize the likes. Right, let's continue. So we are here, we are back to our question. Just a recap. So this is the assessment 10. Let's say you did not join on Saturday, you're only joining today. If you didn't join on Saturday, you're only joining today, please take notes that I'm doing assessment 10 of 2023. I have also put a link to the question on the description. So if you do not have the question, you can go on the description. You're gonna get the question on the description. All right, that is the assessment 10 of 2023. That was equivalent to what you're actually going to write now. It's equivalent to what you're going to write now. Sorry, yes, it's equivalent to what you're going to write now. And is it 6th or the 5th of November? Right, so let's get going. So we started with this question on Saturday. Like I said, most of the work was done on Saturday. It was like a 5-hour stretch class, and we did quite a lot. So we did question 1. We did the full question 1, and in question 1, let me just look at the required question 1. Touched on, there was quite a lot of revenue stuff as well. We had an intangible assets patent, where we had internally generated intangible assets. All right, so we dealt with that calculation of the patent and all of that, calculating what should be capitalized and what should be expensed. And then we went to B. We had a discussion on revenue recognition, the 5 steps. When should we recognize revenue? All right, so that one was B. And then C, we disclosed the notes, the intangible asset notes and the deferred tax notes. So that was what was covered in question 1 on Saturday. If you missed it, please go back and check the part 1 of this class. Go and check the part 1 of this class if you have missed the revision on Saturday. If you're just joining us today, go and check part 1. This is part 2. So question 1 was done, and then we got to question 2. This is where we actually stopped. In question 2, we did the first question. It says draft a report to the board of directors of Diapers Corp to discuss the correct accounting treatment to record the initial acquisition of napkins. Right, so an initial acquisition is what we were actually doing on what we started with on Saturday. All right, so we are then continuing. So we did A. We looked at the steps, 6 steps to actually recognize accusation of interest in a subsidiary company. All right, so we did that. Went through the 6 steps, guys. I gave you guys sort of a formula how you break down your discussions. All right, guys, please like the video. If you have just joined, please like the video. All right, okay, so I broke it down, sort of giving a formula of how you should approach your discussion questions. All right, we broke it down like that. So let's get going. Right, that was the first part. That one was done, and I'm gonna come here. I'm gonna check it off. So that is where we stopped, and we're gonna take it from there. In this class, we're gonna take it from there. Right, I'd like to just make this bigger so we have main focus should be on the question that we're busy with. Right, awesome. So now we're going to part B of question 2. We are going to part B. Right, so part B says prepare the pro forma journal entry to eliminate the intergroup sale of inventory between Diapers Corp and Nappies R Us in the consolidated financial statement of Diapers Corp Group for the financial year ended 30 September 2023. So now you are going to do a pro forma journal. Now take note that pro forma journals of the parent is different to the pro forma journal, or pro forma journal of the subsidiary is different to the pro forma journal of a joint venture or associate. Okay, please take note of that. It's not very different because the foundation is mainly the same, but you need to be able to pick up that now I'm dealing with a joint venture or associate and not a subsidiary, because then it will then change how the journal should be. So that is very important. It's very important that you pick up that aspect. All right, first of all, let's go to our group structure. I remember starting with the group structure. One thing with groups, if you don't have your group structure correctly, you're gonna be in trouble. All right, you're gonna be in trouble if you don't have your group structure. Okay, because how do you know what form of investment you have in the group? How do you know what you're supposed to tackle? Okay, so if you don't have that, there's trouble. Now let's go back to our group structure that we had on Saturday. So we're just gonna go up. Okay, we're gonna go up. This is our group structure. All right, so this is telling us all the companies that are within the group. So we have Diapers is it Diapers Corp? It's supposed to be Corp. Diapers Corp. Yes, Diapers Corp. This is the parent company, right? Then Diapers Corp has interest in napkins. Napkins, they have about 65%, and them having 65% makes them the parents. All right, so napkin is their subsidiary company. All right, then they have Nappies R Us. Nappies R Us, this is their associate company. Now in the question, the pro forma journal that they're referring to is between Diapers Corp and Nappies R Us. Now we just found out here from our group structure that Nappies R Us is actually the associate company. All right, now we did this group structure also in part 1 of this revision. If you had missed it, please go back to the part 1 that we did when we did the structure, so you can pick it up from there. Okay, so it's now I'm dealing with an associate, and I'm not dealing with I'm dealing with an associate. I'm not dealing with a subsidiary. So let us go now to our part B. We're going to answer our part B, but before we do that, we need to get the scenario. Where is the intergroup transaction actually coming from? Where is it? Okay, so Nappies R Us. This is Nappies R Us. Okay, so we're gonna read information on Nappies R Us so that we can also get our pro forma journal properly. Right, Nappies R Us, it says on 1 April 2022, Diapers Corp purchased. Let me just make it a little bigger so that we can all see. I know we started reading this already on Saturday, but I'll just read again. It says on 1 April 2022, Diapers Corp purchased 40,000 of the ordinary shares in Nappies R Us for an amount of 150,000, and the full consideration was immediately paid for in cash. So this is just the beginning, right? This is not the information I need. I'm looking for the intergroup transaction. But I'll read it anyway so that it flows. Okay. It says on this date, all the identifiable assets and liabilities of Nappies R Us were fairly valued and equal to their carrying amounts. From 1 April 2022, Diapers Corp has exercised significant influence. Remember, this was what made us to say that this is an associate. All right, that's how we got to know that this is an associate. Then it says, since okay, the return earnings was also so much. Yes, this is what we are interested in. Since 1 April 2022, Diapers Corp has sold inventory to Nappies R Us. Now, very important, we do not go anywhere without understanding who is actually making the profit, who is selling. So in this situation, they say Diapers. So we have here Diapers Limited. Diapers Limited is making sales to Nappies R Us. Now, who is Diapers and who is Nappies? Diapers is the investor. We'll rather say, can say parent, but this time we'll say investor since they don't have control. Investor. He's the investor, and Nappies R Us is the associates. Right. So, because the parents or the investor is the one selling, they are the one that's going to make the profit. They made a sale, they'll make a profit, and they are receiving their inventory. All right, so normally when we eliminate, we're supposed to eliminate from both sides, right? Eliminate unrealized profit from the diaper side, right, which is coming from their profit from the sales they made, and then eliminate also the part of the unrealized profit from the inventory. But the problem is, this is, remember, this is applying here, they're applying equity method. It's an associate, right? This is an associate, so it's not going to be like that. If it was a subsidiary, I would have simply said credit inventory, but we're not going to credit inventory. What happens here when it's an equity method, all assets and liabilities, so we create two accounts. It's two accounts, sometimes it can be three. All right, in the statement of profit and loss, we have share of profit of associate. This will include all incomes and expenses, so minus, actually, let me put it nicely, all incomes minus expenses. Right. So everything that is an income or an expense must be under this one line item. That's the only line item that is going to be affected, no any other line item. So you're not going to say sales, cost of sales, other income. You're just going to put them all under share of profit of associate. Then if it's a statement of financial position account, we will say balance sheet account. If it is that, then it must go to investment in associate. It will then go to investment in associate. All right. So in this situation now, we have, in this situation, actually having what you call the inventory that is affected by the associates. So because the inventory is the one affected by the associates, what is going to happen is that the inventory is an asset, and all assets and liability should actually be under your, all assets and liability should be under your investment in associate. So it's not the inventory that is going to be affected, it's not the inventory that is affected, it's the investment in associate account that is affected. Okay, so please take note of that. Take note of that. Take note of that. Right. That is what I wanted to show you guys. And also on the other side, on the parent side, this profit is broken into two. What makes my profit is the sales figure, is the sales amount, and the cost of sales. I'm just going to do that. Cost of sales and sales makes up the profit, so we're going to break it down so that it affects sales directly and cost of sales directly. All right, that's the most important. If you can do it like this, you won't get your journals wrong if you know it like this. So you're going to eliminate from both sides. I'm going to eliminate from the parent side. I'm going to eliminate from the associate side. And you know that the parent side, it's profit, which is broken down between sales and cost of sales. On the associate side of thing, it is the inventory, but the inventory should be accounted for under investment in associate. All right, so basically that is how it's done. So with that out of the way, now let's get the figures. So it says Diapers Corp Limited sold inventory to Nappies or us at a gross profit percentage of 30%. This is on selling price, not on cost price. Take note. If it's based on selling price, that means the selling price is the 100%. But if it was based on cost price, the cost price would have been the 100%. Now you would see how the calculation is going to be different from the usual that you are used to, because normally they will base it on cost of sales and not sales. Please don't get used to things, guys. Don't get used to a manner or a way of asking, because it could be different. Okay, don't get used to that, please. All right, so we continue. It then says on the 30th of September 2022, Nappies or us had 60,000 of inventory brought from Diapers Corp that was still on hand, but managed to sell all these by October. All right, so by basically end of last year, we had 60,000 as the closing balance on inventory, which was bought from Diapers. All right, in the current financial year, Nappies or us brought further stock from Diapers Corp for a total of 620,000 as at 30 September 2023, 30,000. This is the closing balance. This is the sales during the year. Now, this is also different. If it was a subsidiary, I would have eliminated that sale in full, but I would not do that when it's an associate or a joint venture. Okay. In subsidiary, it would have been eliminated in full. So in joint venture and associate, where equity method is being applied, we are only interested in the closing balance. All right, basically the balance is the balance at the end of or the last year or this year. That is what we are interested in, and not the what you call and not the sales during the year. So the sales during the year, you can just ignore that. Right, so let's continue. If you're just joining, please like the video. Okay, then we continue. After that, the next thing is now we're going to answer and we're going to do our calculation. So we know that last year it was 60,000. This year we had 30,000. Okay, and then it says the net profit is so much. We're gonna use that later. So I want to do my pro forma journal. Okay, let me do it this side. This thing is not moving. Okay, I'm gonna do it this side. So the pro forma journal is coming from B. Gosh, my line is already skewed. Okay, let me just use a ruler this time around. Let's have a clean line. Now this ruler is not moving. Oh no, guys. The laptop is... Okay, there it is. It was freezing. Alright. Okay, you see how clean my lines are when I use a ruler. But when I don't use a ruler, my lines are just something else. Okay. So we're good. There we have our debits and our credits. All right. So we want to eliminate the revenue and the cost of sales. Remember the profit, we're eliminating profit from the parent side is going to be from revenue and cost of sales, and from the associate side is going to be from investment in associate. But now we had a balance last year. The last year one, once it goes last year, the balance last year will affect return earnings and not investment in associates. I want you to take note of that. So that's basically where the previous balance affects the returned earnings, while the current balance will affect investment in associate directly. Ne? So the last year one, it goes to return earnings. So let's start. So we're going to start with the 2022 balance, then we're going to have the 2023 balance. I always encourage students to put dates on their journals. So 30 September 2022. This is last year. So last year the journal is going to be different. Now before I do the last year one, I'm even beginning to think that let me rather do the current one that students are used to. Guys, forgive me, the ruler is going to waste my time. Right, so I'm going to do the ones we are used to. All right, so 30 September. I want to skip this so to show you what happens in the previous year. This is the one we are used to, the current year one. That's the one we are used to, isn't it? So I want to eliminate the unrealized profit from both sides, right? From the parent side, I want to eliminate it from revenue and cost of sales. So to eliminate something from revenue, you're basically going to debit it, because revenue is an income and income increase on the credit side. And for me to decrease it, I'm going to debit it. So I'm going to have here revenue, or you could say sales, same thing, revenue. Then I'm going to, that is going to be debited. Cost of sales is going to be credited because it's a reversal. Cost of sales. All right, so this will be the parent side, and then from the associate side, it's going to be investment in associates. Okay, guys, no time for rulers. The ruler is going to waste my time. I'm just going to do that. Associates. Okay, this is a statement of financial position accounts. So this is for the current year, right? In the current year, this is what you have in the current year. Then we start here now with the calculation. All right, so let's go. Our revenue. So we go back to the information. So in the current year, what we have at hand is 30,000. So we have 30,000 at hand. And how much do we have? How much interest do we have in this company? Remember, when you are accounting for this in equity method, you focus only on your portion. How much of your portion are you actually how much interest do you have? How much interest do you have? So that's where you're going to focus. So when I go back to my group structure, you see here that we actually have 40%. Okay, the associate has 40%. So they focus on their 40%. Right, so my revenue was my 100%. So that's 30,000. That was my 100% revenue times 40% on. I'm focusing on my interest. Okay, so we take 30,000 multiply by 40%. That will be the revenue, the share of your revenue, right? So it's going to be 12,000. So I'll come here and debit revenue with 12,000. All right, and then cost of sales on the other hand. Remember remember the gross profit was based on sales. So sales was the 100%. So therefore it's going to be 30,000 multiplied by what I'm looking for. Now, what was my gross profit percentage? So we go back. My gross profit percentage. So they said it was gross profit percentage of 30% on selling price. So 30% minus 100 is 70%. So my cost of sales is going to be 70 over 100. Then don't forget your portion. You only have 40%. Whatever you do must be limited to the portion that you have in this business. So 30,000 times 70 divided by 100. That gives us the cost of sales. All right, and then multiply by 40%, which is your interest. So that is my cost of sales is going to be 8,400. All right, then investment. This is the unrealized, the profit parts. The unrealized profit. Remember these two, when you take this minus this will give you the profit. Here we're only just going to put the profit amount. All right, so again 30,000 was the selling price, multiplied by 30%, 30 over 100, because it was based on selling price. This multiplied by 40%. 40% is your interest in the business, right? So 30,000 multiplied by 30% multiplied by 40%. This is going to give 3,600. Remember, your debit must equal your credit. So the total debit must equal total credit. So this transaction or intergroup transaction is actually done. This is in the current year, and this is the one we know and we are used to. I wanted to start with this one so that when I go to the previous one, you're able to see the difference. You're able to see how you can move to the previous one. All right. Now, when unrealized profit is affected, remember tax is also affected. So we need to account for the tax side of things. All right, so I explained this to students, so just check this. Let me put it here as well. So your profit and loss, the tax that would affect in profit and loss is income tax expense, and then your statement of financial position, it will be the deferred tax that affect your statement of financial position. Right, please remember it like this. Tax will just be an opposite of what you're doing, guys. It's simple. Nobody should be worrying about tax when it comes to groups. Like, no, when it comes to groups, nobody should worry about tax. Okay, so basically the tax is just going to be an opposite. Since I credited my statement of financial position, it means for tax I'm going to debit it. It goes the opposite, and then profit and loss will now be, so this will be debited, profit and loss will now be credited. Why is it this debited? Because it was the actual figure was credited. So the tax effect of it is going to be the opposite effect. Okay. Then we get to the calculation. So basically the statement of financial position is deferred tax. So I'm going to come there and put deferred tax. And then profit and loss, statement of profit and loss. This is income tax expense. Okay, then the calculation, guys, the calculation is based on the profit figure. It's already a 40%. All right, so there won't be any need for me to multiply by 40 again. This is already a share, a 40% share. So I'm just going to come here and I'm going to say 3,600 multiplied by 27%. Remember, the current tax rate is 27%. All right. So 3,600 times 27%, this is going to give 972. So this is 972. That's my tax. Right. So basically, that's how you account for it. Yeah? That's how you account for this journal. Now, the last year is just going to be an opposite. That's why I started with the current year, because usually you get the current year. This is the closing balance for the current year. Last year is just going to be an opposite of everything. We're just going to do an opposite of everything last year. And then this investment in associate, let me even do this. This figure of last year goes to retained earnings. Right, so now my revenue is now going to be credited, my cost of sales is going to be debited. So it's just like that. The investment in associate, which was credited, now last year we used retained earnings, which is going to be debited. So it's just going to be an opposite of that. So I'm going to have here retained earnings. Let me put this one in a different color. So I'm gonna have retained earnings, okay, as statement of financial position. Then I'm going to have, now please take notes that retained earnings is usually after tax. Okay, so even the tax of retained earnings must be accounted for right there. Okay, but anyways, I'll just show it separately so that we can understand, so that I don't confuse anybody. Right, so my retained earnings is going to be debited, my cost of sales is going to be debited, cost of sales is going to be debited, then my revenue will be credited. Okay, so it's just an opposite of what we have done here, right? And like I said, I want to show this, the tax side of things. I would have put everything of retained earnings in one, but I want to show it just so you guys to see the difference. All right, so here the tax, remember, tax will just do an opposite effect of what happened there. So if my statement of financial position item is debited, the deferred tax will be credited. So here I'm gonna have income tax being debited, income tax expense, and then remember, now we are not using investment in associate, and we say that retained earning tax is usually an after tax amount and must also be there, right there. Okay, so therefore this, even the text value will also go to returned earnings. So I'm putting in a different color because I want you to pay attention to it. I want serious attention onto it. So we're gonna do the calculation, guys. The calculation again is the same. Last year it was 60,000. Let's just go double check the value. The last year value, 2022. Episode hours, there you go. 2022 it was 60,000. Okay, and then it's still 30% the gross profit. So 60,000, that's the revenue value already. We're calculating our portion of 40. That's 40%. So it's 60,000 times 40%, which will give me 24,000. This is being credited this time around. Right, then the cost of sales. The cost of sales is, we take the 60,000 multiplied by, first let's calculate the cost of sales. If the profit was based on sales, so sales would be 100%. 100 minus 30 will be 70, so 70 over 100. What I'm looking for over what I have, multiplied by my share, 40% share. So 60,000 multiplied by 70 divided by 100. This multiplied by 40%. This will give us 16,800. All right. Then the return earnings will be that unrealized profit that is actually going to the associate. So it's just the profit figure that we are calculating here, just like the other one. So this is just the opposite of that one. All right. So 60,000. I'm calculating the profit. So 30 over 100 multiplied by my share of 40%. All right. So it's going to be 60,000 times 30% times 40%. This is going to be 7,000. Let me do this different. 7,200. All right. Then when we come to tax, I'm using the 7,200, which is already the profit figure. This is already the profit figure. I'm going to come here and say 7,200 multiplied by 27%. I don't need to adjust. Again, this is the profit, which is already a share of 40%. So multiply by 27%. Okay, and this will give us 1,944. 1944. That will be my tax. Okay, so guys, that's how it's done. So that was the 2022 last year. This is the current year. That's how you would have eliminated your pro forma journal. This is between the parents and the associate, and not the association, not the subsidiary. With the subsidiary, there would have been slight difference. All right. So that was that. That was question B. So A is done. B is done. We are left with C and D. Remember E, we said it's E, you will do it as general knowledge. All right. So that was that. So it's now time for question. Like I was saying that on Saturday, I did say if you have questions, please write your question on the comment section, so that when I'm done with every question, then I'll come and ask. All right. When I'm done, then I'll come and ask, so that we can also be interactive. It shouldn't just be me doing the question. It should be interactive. All right. So there we are. Right. Let me bring back my video. Let's bring back the video. I am now ready to answer questions pertaining to what I've just done. Right. Okay, guys. So, all right. So we are done with that. So I want to know any question from you guys' side with regard to what we just did, the pro forma journal, the intergroup transaction that was eliminated. Right. Right. Any question from you guys' side? I'm also reading on the what you call the comments. I have not seen a question yet, so still waiting. Do you guys have any question? Was it all understood? If it was understood, you can just maybe put a heart, or you can just an emoji or something. Okay. Let me know so that I can move on to the next question. So I want to move with you. I want it to be interactive. I don't want to just do everything myself. I want to move with you. Okay, you are part of this. This revision is for you, and it's here to help you. Right. So if everything was understood, it's fine. I will move, but I will just give some time. Check everything, make sure you understood everything, and let me know. Let me know. Let me know. Okay. Any question? Were we all good? Did we all understand what we did? The journals, the performer journal, was it understood? If you are just joining the live recording, please do like the video and please do share the link in the groups that you're coming from. Share the links with every accounting student that you know, every FAC3764 student that you know. Please share the link with them. If you're just coming in, like the video and subscribe, guys. Subscribe, please. Don't just come here without subscribing. If you are here and you haven't subscribed, please do subscribe. Do subscribe and like the video. All right, like the video. Please remember, even if I'm going, if you have a question, you can just put it on the comment section and I'll come back to answer your question. All right, I'll come back to answer your questions as we go. Okay, awesome. So I'm going to continue because I think I've asked if you guys are okay, and it seems like you guys are fine. But like I say, if as I continue you have questions, don't hesitate to put it on the comment section. Okay, don't hesitate to put it on the comment section. I will come and answer you guys so we can be interactive. All right, so let's continue. So we are done with the proforma elimination journal on the intragroup transactions of inventory where the parent sold to the associate. So we are done with that, and we're going to move to the next question. We're going to move to the next question. All right, guys, I'll see you again once I'm done with that question. We come again and have a chat. And please remember to keep putting on your comments. Put questions on comments. All right, if you have not subscribed, it will not allow you to comment, so you have to subscribe first and then you can comment. Okay, so with that being said, let us go on. With that being said, let us go on to the next question. Okay, so I'm gonna put off my video. I'm gonna put my video off. Then we're going to continue with the next question. All right, like I said, today I don't want it to be long. The last recording we did was very long, and I got a lot of testimonies, people saying that the class was actually very helpful. I'm glad that I'm able to assist. This is my way of giving back. This is my way of giving back. Yeah, I'm glad I'm able to assist, and I'm really glad that people are understanding. People that join the video are understanding, and I hope it's gonna make a difference in your exam that you're going to write. Okay, guys, so let's continue. I'm gonna put off my video so we can get to serious business. Let's get to the question. Okay, so back to serious business, back to the question. And thank you so much for those of you that are always like responding on time. You make life easy for us, you make life easy for us, so we flow that way. When you're responding on time, we actually flow. So thank you, guys. We continue back to serious business now. Once we're done with that, then we come to the I just want to do this. I want to see this. So then we come to C. C says calculate the consolidated gain or loss on the disposal, and most of the students do not know this one. All right, so most of the students do not know this one because the examples that we have in our guides and the examples that we've worked on are normally when control is not lost. When control is remains, either we sold some of the share and we still remain in control, or we buy shares and we still remain in control. Okay, that's the one that most students are comfortable with. That's the one that most students know. Okay, so this one becomes an issue because now control has been lost completely. We have completely lost control. This company is no longer in our group. It's no longer in a group. There's no more group. This is just any other investment. It's just an IFRS 9 investment, simple investment. We are not in the group anymore. We don't control them anymore. Okay, so Now they want us to calculate the consolidated gain or loss on the disposal of the interest. To do that, we have to get to that part. All right, so we have to calculate. Basically, we're supposed to do our analysis of owner's equity to know what happened on that day, and take it from there. Now, what are the items that you need for you to be able to calculate this gain or loss that they're talking about? So before we even do it, what are the items that are actually needed? What makes up this consolidated gain or loss? I don't want to close anything. Let me underline right here. Right, what makes up this value? So let's do it here. So for me to be able to calculate the consolidated gain or loss, all right, I will need the consideration that we actually received for selling the item. So I need the consideration, number one, consideration received. All right, number two, I'll need the fair value of retained earnings. Okay, the retained earnings in this point, and then I would need the NCI part that is derecognized, the NCI at this date. Okay, that is going to be derecognized, and I'll also need, for me to calculate these, I'll also need to know the actual equity that the goodwill. Let me start with the goodwill. The goodwill that is going to be derecognized on this date, and the total equity. Right, this will make sense in analysis. So I'll advise you guys to do your analysis of owner's equity. In the analysis of owner's equity, it's going to make so much sense, and then we come back to do our calculation. I know it's 8.5 mark, and you may feel like, no, it's wasting time, but it usually directs you well when you do the analysis. I will advise you guys, I know analysis of owner's equity is like a long route, but it's always the best route. You can't really make mistakes with analysis of owner's equity. It is rare for you to make mistakes with analysis of owner's equity. Okay, very, very rare. All right, so I'm going to do the analysis of owner's equity. I'm going to do it on this side. Remember that will be, so let's do C here. We're going to answer C here. The analysis, we're going to do it as a calculation. So I'm going to do it this side. I'm just going to say calculation. And even that analysis was also going to help us big time when you do our statement of changes in equity. All right, so I'm going to, so I'll call it calculation. I'll just say calculation number 2, the analysis of owner's equity of this would be Napkins Limited, which is our subsidiary, Napkins Limited. All right, okay, so by now everybody should have mastered their analysis of owner's equity. Should have been mastered, really, like seriously mastered. All right, so then we're gonna have our NCI column. Then we're gonna have our parents column, which is divided into 2, the at acquisition and since acquisition. Then we're gonna have the total column. So my total column is my 100% column at since. Right, the name of the parent is Diapers Corp. Diapers, I'll just put diapers. All right, so the total column is the 100% column, and then Diapers initially had let's go back to the group structure so it can direct us well. Okay, they initially had 65%, and later on they moved to 10%. So from 65 to 10%. Okay, and when did this occur? It occurred in June 2023 during the year. All right, so it's basically we sold during the year. So from 65 to 10%. So whenever there's a change in ownership, you always have to show your percentage this way. So you're starting from where you started, the starting percentage, to the ending percentage. All right, and then now with the NCI, remember there will not be any group afterwards, so it will even be pointless to show the other side. We'll just show the 35. Okay, so then we start with a normal analysis of equity like we know it until we get to that time until we get to the time where we have to now close everything. Remember, we're going up until what is it, June? We're going up until June 2023, 1st June 2023, where the item actually occurred. So if I go to my financial period, right, my financial period begins here in October, so up until June. I'll just put June somewhere here, 1 June 2023. So from here to here, so it's October, November, December, January, February, March, April, May. I cannot count June because it's the beginning. So it is basically 8 months. So we're going to do 8 months into the year. And after that, control is lost. From there, control is lost. All right, so let's get working. Let's get working. Right, we start at acquisition. This is where we want to know, is this investment worth it? What are we paying versus what we are going to receive? Is it worth it? All right, so we continue here. We start with our share capital. Then we're going to have retained earnings is always there, and then we will have adjustments if there is any. Okay, so we continue. Where was I? All right, guys, can I have 1 minute? I'll be with you now. 1 minute. All right, okay, I'm back. Yes, let's continue. Right, so we're basically we're going back to the transaction that talked about napkins. All right, the napkins, our subsidiary. Okay, so we want to know how much is our share capital and how much is our return earnings. The share capital is not expected to change at all, but the return earnings changes, and so therefore we want the return earnings at acquisition date on the 1st October 2020. Okay, so my return earnings on this date, you can see, is 311,000. All right, you can see that it's 311,000, and then they're telling us how the consideration was also purchased, which you're going to calculate. And now the share capital. So the share capital in napkin is 100,000. Share capital 100,000. Return earning 311. Right. Let's put it down. Right, share capital 100,000. Return earnings 311. Okay, now remember, these were not the only items. There were other adjustments that we had to make as well to our equity, or to our net assets. So we're gonna go check out those adjustments. Okay, we're going to check those adjustments again under napkins. Investment in napkins. There we go. All right. So this, it gave us that, then it gave us the consideration. We're going to deal with the consideration just now. Then it says on July 2020, Napkins Corp began a research and development project for new diaper technology that will allow for the creation of a thinner and more flexible range of diapers without sacrificing absorbency. On 1 October 2020, the project met the definition of an intangible asset in accordance with IS 38 intangible assets, but could not be recognized in the separate financial statement of Napkins Corp, as the probability of future economic benefit could not be demonstrated. But if it meets the definition, then it should be recognized. Okay, so it says on 1 October 2020, Napkins Corp had expense development costs to the value of 45,000 and in its separate financial statements. The fair value of the development cost on 1 October 2020 was 50,000. Now, I explained this on Saturday that because this asset was not recognized as an asset, it was expensed. It means we are not even going to check the difference. We're not even adjusting. We are using the full fair value. So in other words, it was sitting on a 0, and then now the fair value is 50. All right, so I'm comparing 50 to 0. So my adjustment is 50. All right, on my intangible assets, my adjustment is 50. And remember, this intangible asset, we are told it has an indefinite useful life. So it is not because it has indefinite useful life, it's going to be treated like land. For tax purposes, capital gain would have kicked in with 80% inclusion rate because of the fact that it has an indefinite useful life. Please take note of that. All right. So and then we continue with that information that we just read there. You're going to come and put it here. I'm going to put this in red because it's an adjustment. So intangible assets, I am completely ignoring the 45 that was treated as an expense. I'm interested in the fair value, and the value of this was 0. Now it's the fair value is 50, so 50,000 what I'm interested in. Then the tax effect, remember, because of it has an indefinite useful life, it's going to have a capital gain implication. So it's going to be 50,000 multiplied by 80% multiplied by 27%. 80% for capital gain inclusion rate, 27%, that's the tax rate. All right, so 50,000 times 80% times 27%. Sorry, 50,000 times 80% times 27%. Right, so I'm getting 10,800. Okay, tax will have an opposite effect all the time because it was positive, tax will be negative. Right, guys, those are the only items that affected my equity. As you can see, I'm not sharing them yet. This is another way to be faster with your analysis. All right, so you don't have to share everything line by line, just share the total. So once I get here, now I'm going to calculate my total equity. So it's 100,000 plus 311,000 plus 50,000, then minus 10,800. Okay, so I'm getting 450,200. 450,200. So that is my total value. Then I will share between the parent and the NCI. So this multiplied by 65, this will give me 292 630. Okay, and then the 35% would give me, so if you calculate 35%, I'm going to get 157,570. Right, then from there I'm going to skip a line. We are going to skip a line for my goodwill or my gain on bargain purchase. Then I'm going to calculate my consideration paid and my NCI. Okay, so we were told that NCI is a proportionate share. We read it on Saturday. It was a proportionate share, so it becomes easy for us. It means it will not have any goodwill. It will just remain the way it is. This is its proportionate share. All right, so the work is now here. Now we need to calculate our consideration paid. We're going to calculate our consideration paid. So let's go check out what we were told on the consideration paid. I'm going back to the information that talks about napkins again. We're back to napkins and talks about it here. So it says it's going to be shares that we're going to give shares and we're going to have cash. So the cash value is 220 and then the share value, we're going to use the fair value per share, which was 250. So 40,000 share multiplied by 250 plus 220,000. So now that I have that, I'm going back here. I mean, you're seeing where I'm getting my figures from. So we have 220,000 cash plus shares, 40,000 shares multiplied by the fair value of R2.50 each per share. This will give us the total consideration that was supposed to have been paid. All right, so 40,000 shares multiplied by R2.50, that's 100,000. This plus 220, this plus 220,000, so I'm getting 320. So the actual consideration is 320,000. Right, so you can see the consideration being paid is actually higher. The consideration being paid is higher than the equity that we are actually receiving. Therefore, this is going to give me a goodwill. So when you compare the two, it's going to give me a goodwill. All right, that 320,000 minus 292, 630. This will give me a goodwill of 27,370, which is also the total. All right, then to my total column, it's now going to give me 477,570. I just added the two to get the total. All right, so at acquisition, that's what we're basically doing. When I calculate, is this investment worth it? What you are paying versus what you are receiving, and if there's a goodwill, account for goodwill. If there's a gain on bargain purchase, also account for that. Right, that's at acquisition. Then since acquisition, we want to know what are the movements in our equity. All right, more especially our returned earnings. What is the movement in it? So then we go to since acquisition. Remember, since acquisition is that period that falls between acquisition date and the beginning of the current year. All right, so we go there, we check the movement in our returned earnings. Now, one thing about napkins did not have intergroup transactions. Let me just prove it. I know we read on it on Saturday. So napkins did not have any intergroup transactions. All right, so it just talked about that at acquisition, and then during the year we sold our shares, some of the shares. All right, and then they gave us the fair value of the remaining interest is that, and that in September. So that's basically it. Nothing else happened. There was no intergroup transaction, so there's no need for us to look for was the intergroup transaction that affected return earnings. None whatsoever. So we come here, we have returned earnings. All right, so here I'm interested in the movement in return earnings. So I want return earnings at the beginning of the current year. So I'm going to check return earnings at the beginning of the current year. Return earnings beginning of the current year. I go back to my trial balance. I'm going to go under credits. Return earnings, check the date, guys. This is exactly the beginning of the current year. If you don't get your date right, you're in trouble. If you don't get your date right, you're in trouble. All right, so I don't understand what is going on in this question. Just a minute, my laptop is just acting up. It's freezing. It's just being it. Okay, let's try again. Okay, perfect. So that is the date, and that's the one I want. And for napkins, it was 420. So I want the return earnings at the beginning of the year, and then I'm going to minus return earnings at acquisition. 420 minus return earnings at acquisition. So there we go, 420,000 minus 311, which was at acquisition. So that will be the movement in returned earnings. All right, the laptop is frozen again. Please bear with me. Please bear with me. No technology, how it can be sometimes. Okay, it's back. All right, so then we find the difference. 420 minus 311,000. This will give 109,000. Right, the 109,000 is then shared between parent and the NCI times 65 and 35. Now I'm no longer in the at acquisition column. I'm now in the since acquisition column. So everything I'll be doing now will be on the since column. So 7850. This is going to be 38,150. Please remember, if you have questions, start writing your questions already so that when I'm done, I can answer them next. Right, so we can be a little bit quicker today and not today we don't want to stay long, very long, like last time. All right, so we don't want to stay long like last time today. Okay. All right, let's continue. If you have questions, please be putting it already. Keep putting your questions. Keep putting your questions. If you have just joined, please like the video. Please like the video if you have just joined. Thank you. And subscribe if you haven't subscribed. Also, please share the links. Okay, so let's continue. We did that. I think let me make it a little bit smaller. So that was with since acquisition. I'm now going into the current year. Current year now. All right. So in the current year, we're interested in the profit, but profit of what, guys? We're interested in the profit for the first 8 months. Ne? It's the profit for the first 8 months. That's what we're interested in. And that's it. The first 8 months profit. Okay, so we're going to calculate profit for the first 8 months as well as account for the dividends, and then we move from there. All right, so let's continue. Let's go get our profit stuff, profit for the year. Okay, we're gonna do our calculation on the side. So I'm going back here. All right. So basically what we're looking for is revenue, is other income, cost of sales, other expenses, income tax. Those are all the figures that we are looking for. Okay, right. So my revenue is 455. 455. I'm losing. I can't see properly what date is. 455, and then 150. That's my other income. Okay, let's write those two, then we come for the others. Okay, 455 and 150. 455,000 plus 150,000, right, minus. So we now go to the expenses. Minus. Guys, if you're just joining, please like the video. Okay, we go to the expenses. Cost of sales 345. Is that just making sure? Yeah, 345, 45, 170. I think I took the wrong figure. So cost of sales is actually right. This is dividend. Yes, it's correct. It's correct. 345, 45, 170. 345, 45, 170. Okay, that's basically that. That's our figure. Let's go put it down. Okay, there we go. So we want to put down our expenses, our cost of sales, 345,000. Then our other expenses, 45,000, and our tax was 170,000. Right, guys, this makes up our profit for the year. This makes up profit for the year, and remember we're calculating this by 8 months. Okay, I did that when we're doing the timeline. I showed you guys on the timeline. So this is, we're calculating 8 months profits. We're calculating 8 months profit. All right, so 109,000. Why am I going to 109? Sorry, 455,000 plus 150,000 minus 345,000 minus 45,000 minus 170,000, right? Then it gives 45,000. Multiply this by 8, divide by 12. I'm getting 30,000. So my profit for the year for 8 months is 30,000. So this is where we are done now. This group napkins is no longer going to be part of our groups. We have sold all our shares. We've lost control at this point in time. So we multiply this by 65. We still had 65. So the parent side is 19,500, and the NCI will get the what is it called, 35% of that, which is 10,500. Right, don't forget dividends. Let's also put dividends paid. Don't forget dividends paid. Right, it was 5,000. We saw that already. 5,000 when we were there. We share the 5,000 times 65. That will be 3,250, and then the NCI is gonna be 1,750. All right, at this point in time we are done. We have done everything. We're gonna total all the column. Now we want to calculate what is the total equity, and basically the total equity that is going to be derecognized. Ne? So I'm going to do this in blue. Total equity. Right, at this point in time, so we derecognize everything. So we calculate, we start from the total column on the top, 477,570 plus 109,000 plus 30,000 minus 5,000. Okay, I hope I've not left something out. All right, so what I'm getting here is 611,570. 611,570, that's what I'm getting. And then on my other side, oh, it's blocking. On my other side, 320. And then on this column here, okay, so 850 plus 19,500 minus 3,250. And then my NCI side of things is 157,570 plus 38,150 plus 10,500 minus 1,750. So it's 204,470. Okay, so this is me totaling what we have at the moment. All right, now I want to get to the actual calculation. We now want to get to the actual calculation, and it always helps to just try some things. This must equal this, ne? So I'm just gonna try to see if my calculations are all fine. 1, 2, 3 must equal the total column. So let's go 320,000 plus 87,100 plus 204,470. All right, okay, that it does give me my 611,570. Okay, so I am good. Right, now that I've done all those calculations that we have right there looking at us, now that we have done all of that, now let us continue the other side. Let us answer now the question that they wanted from us. Remember, we have now the information that we can use to answer the question. All right, so we go on. It says calculate the consolidated gain or loss on the disposal of interest in Napkins Corp that will be disclosed in the consolidated financial statement of Diapers Corp Group for the financial year ended 30 September 2023. So now that I've done my analysis, it's going to be easier for me to do my calculation. Right, I've already given us a hint of the items that are supposed to be in the calculation: consideration received, retained earnings, NCI, goodwill, equity, total equity. Remember, the total equity must not include goodwill again, otherwise you'll be including it twice. Okay, so we then continue. So we want, first thing first, the fair value of the consideration received. So fair value of consideration received. So that's the first thing we want. So let's go back to the information that talks about them selling their shares out. Let's go to the information that talks about that. So it's here. It says oh, not nappies, are RCs here by Napkins. So they start talking about sale here. Okay, so it says here the board chairperson suggested that to limit the company's exposure to risk, some of the shares in the Napkins Corp should be sold. On 1 June 2023, Diapers Corp sold 55,000. Guys, the laptop. My God. All right. Sorry. Technology. Technology is not nice, ne? Anyways, it's back again. Okay, 1 June 2023, Diapers Corp sold 55,000 of their shares in Napkins Corp for an amount of 350. So that's the amount we're talking about, the 350. On this day, Diapers Corp lost control of the Napkins Corp, and the remaining investment was held as financial assets in accordance with IFRS 9 financial instrument. The fair value of the remaining interest. This is the fair value of the remaining interest is 150. Let me start with, first of all, what was the consideration received? Fair value of what? The consideration. So it was 350. So I'm going to take my 300. Guys, please pay attention to this, ne? I have a feeling that something like similar like this can come in the exam. So just please pay attention here, ne? Right. So that we have that. Then the fair value of the remaining interest, which is going to go to your return earnings. Where is that? The fair value of remaining interest. We read it just now. Yeah. So the fair value of the remaining interest is 150,000. Okay. Then fair value of remaining interest, 150. Okay, so once that one is done, now we have to also now look at the other from our analysis. Now the NCI derecognize. Okay, NCI derecognize, and then also the equity derecognize. Equity, or you can say net assets derecognize. This is going to come from the analysis of owner's equity that we did, and of course also the goodwill derecognized. All right, so all of these are coming from that side. Now let's go get our items. Let's start with our NCI. NCI is 204,470. 204,470, this figure here. So we'll take it. Now imagine if you didn't do your analysis, you won't be able to get your figure, eh? And you try to do shortcut and you're gonna get stuck in your web. You know what you call a web? Spider web. You'll be stuck in the spider web because you yourself, you think you think you have it right, you think you know what you're doing, but the method that you applied is just complicated for yourself, so you get stuck in your own web and there's no way out. So what students will normally do, they will try other methods because they want to take a shortcut and then get stuck in the shortcut and realize, oh my god, no, I just need to come back to my analysis, and then they jump back into the analysis again. All right, so the choice is yours. The choice is yours, guys. Okay, so 204 470, let's go write it down. 204 470. Then it is the equity. Then the equity must be minus. The equity must be minus. So the equity was 61570. Remember to remove goodwill because we'll end up accounting for it twice. So it was 611,570 minus the goodwill that I'm going to account for now, and the goodwill is 27,570. Hey, my handwriting is not so good, eh? Was it 5 or was it 3? Yeah. Okay, I'm just going to redo this calculation. See what I was saying, getting stuck in your own web. I wrote this, but I can't see it. And you don't want this kind of situation, eh? So it's 27,370. Okay, 370. Don't be stuck up in your own web where you write your own thing that you yourself you cannot even see. So what would happen to the lecturer? Okay, I'm gonna write it here. This is where it's supposed to be. That is why we have to remove it here so we can show it separately. Okay guys, I've got a feeling that this can come, so please make sure that you are grasping. Make sure you understand this, make sure you work on this and remember this. Right, so once you minus that, it's gonna give us 584,200. These two are gonna be minus, and from there we can calculate that gain or loss, in depending if it's a positive it's a gain, if it's a negative it's a loss. Okay, then we'll be able to calculate the gain or loss on disposal. So let's find the total. Okay, so it's my fair value that I received plus the fair value of what is remaining plus the NCR that is being derecognized, then minus the total equity minus the deferred not deferred tax, goodwill. So let's do this. 350,000 plus 150,000 plus 204 470. All right. Guys, I did an error here. Let me start again. 350,000 plus 150,000 plus 204 470. So I'm getting 704 470. Then minus 584 200 minus 27 370, and I'm getting 92. It's a positive amount. I'm getting 92,900. So this is a gain on disposal. All right, so this is my gain, consolidated gain on disposal of interest. Consolidated gain on disposal of interest. All right, and then voila, then you would have been done. But now it looks like you did a lot of work for 8.5 marks. I know sometimes it looks like that, but remember this same analysis is still going to be used in the statement of changes in equity. Still going to use it that side, so it's not a waste. You have not wasted time. Okay, it's not a waste, not at all, not at all. So C is also done, and remember what we do, guys, just to be interactive. So C is done, and I did say you should write down your questions down so that we can talk about the questions before we move on. But if you also do understand everything, just notify me, even with emoji. You can just say I understand, or you can just put a sharp or something like that, any emoji, just so I can know and move on. What I don't want is to move on without you. I don't want to move on without you. Okay, so it is question time. Let's go. Let me put back my video on so we can do our questions. All right, guys, I'm back again. I'm back again. All right, so we managed to calculate our consolidated gain on disposal of interest. All right, I took you guys through all the steps, and I did say if you have questions, please holla because I don't want to move without you. I don't want to leave you behind. Now, it doesn't help for me to just come there and just do the question without you. All right, so I need you to be here. So, guys, any question from your side? How was it? Did you guys understand all the explanation that I just gave? And I'm insisting, guys, I've got a feeling that this may come. It may not come, I'm just saying. But if it does come, please, I would really suggest that you really go and learn this, because this is not your usual kind of questions. Normally, when they are testing change in ownership, normally they would test change in ownership where control is not lost. So that's the one we are used to. Everybody is used to that, where control is not lost. Like we would sell a portion and still remain in control, or we'll buy a portion and still remain in control. So we're used to where control is not lost. We were still in control. But in this situation, control was completely gone, like completely gone, and the calculation is a little bit different to the one we are used to. Okay. All right, guys. Questions? Questions? Before we do the last one and say goodbye for today and all the best for your exam. This is your very last class. I don't know if you guys are going to have other revisions somewhere, but I know this is definitely for most people, this is their last class before they finally meet the exam. Again, I'm insisting, guys. I'm really saying and encouraging you guys to go and write. I know some of you guys at this point in time, you're like, I've had it here. Please don't give up. This is nothing. CTA is waiting for you. CTA is waiting for you. This is basically nothing. So stick around and hold on. Like, hold on. Pray a lot. Just keep praying. Let the Heavenly Father help you. So just stick around. Don't give up. Okay? Don't give up. Even if it means you have not studied a lot and you're just gonna study now, just do that. I also did say, I was telling you guys, I think before this question, that at this point in time, if you know yourself and be very honest with yourself. If you know you haven't been studying that much and you want to attempt to pass, please focus on these three. Number one is what we are doing now, assessment 10 of 2023. Number two is your assessment 9 of 2023 last year. So assessment 10 and 9 of 2023, then you do assessment 5 of 2024. These three, if you focus on these three, then you can actually do well in your exam, provided that you're actually doing the question and not just copy pasting it. You're not just, remember, we are totally against that copy paste situation, right? Provided you have done the question and you've understood the question and you marked yourself, you looked at the memorandum and you marked yourself, and then you figure your wrongs. That is how you're gonna pass. So it is these three assessments that you do. I repeat, assessment 9 and 10 of 2023 of last year, and assessment 5 that you currently wrote. Those three, if you want to pass right now in this last minute situation, those are your solutions. Okay, nothing else. Don't try to read many things, ne? You will see things. Remember, there was quite a lot. The content, the problem with FAC3764 is that the content was too much. Too many topics all fused into one, and you're writing one exam. So if you want to study now, you may just be frustrated and you may just lose hope and you may just give up even worse. So what you're doing now is just practicing. It is application, because the exam is all about application. Reading and not applying is not enough to make you pass, but applying is enough to make you pass, provided you're applying correctly and you're honest with yourself. You're not lying by looking at the memo and thinking you know. You don't. Do it first. Okay, so basically that's it, guys. That is it. That is your solution at this point in time. And again, I'm not seeing questions. All right, if you're good, just let me know. Maybe emoji or maybe a heart or something, then we know that, okay, Naomi, everything is going well. So far so good. Yeah, you can even say so far so good. Just say something so I can move. All right, I know that we are together, we are moving together. Say something so we can move. Say something so we can move. All right, guys, please, guys, this is not the end of the world. It's not the end of the world. I know you want to be a CA so badly, but please, it's really sad in my heart that I heard about like 2 people that died in our field. Oh my God, guys. Sure, please, like, just take care of yourself. Make sure your mental health is fine. Make sure you're fine, please. And this is not the end of the world, please. I understand that we're all dreaming and we all want this so badly, but hey, we can only do what we can do. It is what it is. We study, we attend classes, we practice, all right, that we do the best that we can do, and that is it. If your best, if you know, unless if you know you have not given your best, but if you know you have given your best, then it is what it is, guys. It is what it is. Please don't let things get to you. Like, really, it's really sad. It's really sad to hear that people are dying in this field because of stress and all of that, ne? Right, okay, guys, I'm going to go to the last question now. Please write your questions as I'm going so that we can finish faster and not take long like we did on Saturday. All right, so I'm going back now, back to business, back to real work, real business. So I'm gonna put off the video so that we can go back to our work. Okay, let's be serious now, accountants. We're gonna be serious now. All right, so let's go. Putting off my video. Like I was saying, guys, once again, thank you so much for those of you that are really responding on time. It's just really helping the class to move. Thank you so much. And again, guys, if you're just joining, I see the views are going up. If you're just joining, please like the video. Like, guys, like. If you haven't liked, please like the video. And also share the links with your friends. Share the links with the groups you're coming from. Please just share the links. Yeah. And subscribe if you haven't subscribed yet. Oh my God, you're doing very bad by not subscribing. Come on, guys. This is my way of giving back. So please subscribe so that the channel can grow. And also like, especially liking is when the more likes we have, the more YouTube is gonna recommend it to the people that actually need it. Okay. So that is why we're insisting on the likes. Anyways, back to work, back to business, back to serious work. So let's finish up this question. Right, remember E is homework, That one is just general knowledge, basically infusing your auditing in it as well. All right, so let's continue. It says, D says prepare. Let me just do like this. And guys, one thing about statement of changes in equity is that it's statement of changes in equity, guys. It's the one that is a little bit tricky in comparison to all the other statements, especially when it comes to groups. So I need your full focus, like full focus. Okay, let's get going. Right, so it says prepare the consolidated statement of changes in equity for the Diapers Corp group for the financial year ended 30 September 2023. Please note the total column of the consolidated statement of changes in equity is not required. Guys, one thing about statement of changes in equity, it's especially the retained earnings. The retained earning column is usually the one with issues. That's the one bringing issues to us. We are all good until it comes and then it starts bringing us issues. All right. Okay, let's get going. D, we're gonna do quite a number of calculations, so bear with me and please follow attentively. Right, so diapers corp group, we want to do a consolidated statement of changes in equity as at 30 September 2023. Okay, so that's what you want to do. And guys, you are now in third year. At this level now, we're expecting you guys to understand your formats. All right, we're expecting you guys to know your formats. Very important. Know the format of all the statements that you're gonna have. You need to know the format of them all. All right. Okay. So we have with us now, so far we know that share capital, return earnings is going to be there, then NCI is going to be there. So these three are always there. Share capital in a group situation, I'm talking about a group situation. In a group situation, share capital, return earnings, non-controlling interests are always going to be there. Then we could also have revaluation surplus and market to market. But in this question, I did not see anything on revaluation surplus or adjustment on that during the year. I've not seen that. But there was that part of the fair value of the, remember, the investment is now a simple investment, so it's definitely going to bring in market to market, because you have to calculate a fair value adjustment, right? And they did say they're electing to account for their fair value adjustment under other comprehensive income, right? So we come here, the items we have are share capital. Now my lines are skew, guys. I'm really avoiding to use that calculator. I feel like it's just taking my time, so I'll try by all means to have straight lines. I'm gonna try. Okay, that's my try. All right, then we have returned earnings. Returned earnings. Then we have markets to market reserve, and after that we're gonna have non-controlling interest. Perfect. So where we are now, this is how these are the items we feel is gonna be there, and then we're gonna put the format down as well. Like I was saying, guys, you need to know your format. That's what's gonna help you to actually stay. That's what's gonna help you to actually finish your paper on time. Okay, you'll be able to finish your paper on time if you know your formats. Right, then balance at beginning of the year. All right, then we're gonna have changes in equity. All right, so we all know that we're gonna have profit for the year, definitely profit for the year. That one we definitely know about that. You're gonna have profit for the year. We're going to have other comprehensive income as well because of the fair value adjustment. Other comprehensive income. Then we're gonna have definitely dividends. But remember, we also sold assets, so we had disposal of interest, not asset. We sold shares, I said asset, sorry, shares. And then dividends. So I'm leaving some space in case there's something else. Dividend paid. This is as much as we can remember, and then we close. We leave space just in case we'll slot somewhere. Balance at end of the year. Sorry guys, so we're not gonna get the easy marks, guys. The easy marks are your share capital and dividends, because these two, only the parents' share capital and dividends remained. The others of the subsidiary and the joint venture and associate are only eliminated at acquisition, right? So it's only the parents' share capital and retained earnings that remains. So these are the easy marks. So we're gonna go to our trial balance and get the share capital of the parent and the dividends paid of the parents. All right, so share capital of the parent is 200,000, and then dividends paid it's 70,000. So 270,000. We take only those figures as is. So those are my easy marks. I'm gonna come and put my easy marks, and then we start working. Okay, share capital is not going to change in this level. Basically, in your third year, share capital is not going to change at all. because it's gonna get complicated if they have to change the share capital. All right, so they're trying to simplify groups, but groups can be very, very broad. Try to simplify it, and one thing is share capital is not going to change in this level. All right, so we have here 200,000, means there will be no changes here, and the total will also be 200,000. Share capital done. Dividends is going to be under retained earnings. The 70,000 is going to minus my retained earnings. All right, so that is that. And then the NCI values, the NCI, we're going to take them from the analysis of owner's equity. See what I was talking about? Most of the things in the NCI is being taken from the analysis of owner's equity. Okay, right. So let's start with our opening balance of, let's start with the opening balance of NCI, and then we'll take the profit and the dividends and so forth. Right, so the opening balance, I'm going to go to my analysis. The opening balance of the NCI is equal to the NCI at acquisition and since acquisition. So I'm just going to be doing the calculations underneath. I'll call them in letters. All right, so I'm taking my 157,570, 157,570. I'm adding the since acquisition, the movement of 38,150. This is taken straight from the analysis. 38,150. This is the NCI column. That's how I get my opening balance of my NCI column. So it's 157,570 plus 38,150. This will give me 195,720. 195,720. So I'm gonna come here. This becomes my opening balance. 195,720. That's for my NCI. Right. Then the profits, we also go and take the profits. Is 10,500. Profit for the year for the NCI 10,500. Other comprehensive income that doesn't affect them. Then they had dividends. Okay, actually this was supposed to come here because the dividends is before we close. So let me just move this here. This is actually closing the, so I'll put it here. Let me put it in color. Disposal of interest. Okay, and then the dividends, let's deal with the dividend on the NCI. Guys, NCI basically comes from the analysis. It's just what you did in your analysis. So we dealt with that. It's 1750, and then 204 470. That's the closing. 1750. That's my dividend. 1750. And then this is then closed. We close everything. 204 470, if I'm not mistaken. This amount was already calculated, this figure, so there's no need to recalculate it. Otherwise you could have also recalculated. 204 470. It's basically the total. We are closing off NCI. Remember, there's no more group at the end of the year. There's no more group, so that will just be dashed. No group anymore. Then the market to market reserve. Let me also deal with that one. I'll call this B. The market to market reserve is basically now the new investment that we have. It's now the new investment, and it's gonna keep increasing or decreasing in fair value. So I want to go back here with, we given the 150. Okay, so you see the 150 was on June when it was sold, but later it has increased to 155 in September. So we have to account for the fair value adjustment. And market to market, guys, please note that market to market also has implication of capital gain. It also has capital gain implication. Okay, so 155 minus 150. So we're gonna come here and put 155,000 minus 150,000. That is going to be 5 5,000. All right. Now this 5,000, we actually need it after tax. Okay, so what we do with the 5,000, we're going to multiply, or okay, let's rather do this. Let's do the tax separate. So the tax is going to be 5,000 multiplied by 80% multiplied by 27%. Right, so 5,000 multiplied by 80 multiplied by 27%. This is giving 1,080. So I'm gonna do this so we can get the amount after tax. Okay, because the equity must be shown after tax. So I'm getting 3,920. So that's the figure that I'm gonna put there. Okay, we did say we put, yeah, technology has started with me again. Okay, yeah, my laptop is frozen. All right, let's hope it's gonna move. Okay, it has moved. It has moved. So other comprehensive income here, 3,920. This is B. Okay, so we got our calculation from that. This is also not going to change after this because this happened even at the end of the year. So the only thing we're left with is the return earnings, which we all know that return earnings is the one that actually is the problem in the statement of changes in equity. It's return earnings that's the problem. Okay. Right, so we want to finish this now. We want to calculate the balance and the profit as well, especially the profits. Okay, especially if we didn't do the statement of profit and loss. Anyways, let's start with the opening balance. Then we calculate the profit. So the opening balance, you take the opening balance of the parent, then you take the since accusation portion of the parent on the analysis of owner's equity. You do that for what is it called, the subsidiary. You do that for the associate as well. Okay, so basically that's how you calculate your retained earnings. I'm just going to try to put a formula. So retained earnings at beginning of the year will actually equal to retained earnings opening balance of the parent company, right, plus return earnings movement in subsidiary analysis, and then return earnings movement. Okay, this has to be since acquisition. Again, same thing. This one is movement, but this movement now in associates, and it's also on the analysis if you do the analysis. Okay, so that's how you get your opening balance of return earnings. So let's start with the parent one, which is given. The one for diapers one is given, so it's easier to start with the easy things first. Always do the easy things before you get to the hard ones. I think I was giving you guys advice on Saturday how you should tackle your exam. Always do the easy things first. All right, so the return earnings of the parent is 1,240. 1,240. Okay, 1,240. So I'm gonna come and take my 1,240. 1,240,000. Then for the subsidiary, I go to the analysis that I've already done. For my subsidiary, under my analysis, the parent's portion is this. This is that. So 70,850. 70,850. Okay, so I'll come here, 78.50. Where am I? Okay. Right, plus we have to do the same thing with the what is it called, the associates. So we need to know what was their movement. We'll take the retained earnings at the beginning of the year minus retained earnings since acquisition. All right, we will do that. So let's go. Toys R Us. Let's look at the information on Toys R Us. Okay, so they said their retained earnings at acquisition was 180,000, and then let's check the beginning of the year. Beginning of the year is 205. So 205, 180. 205, 180. So we didn't do the analysis for them, but we're trying to take the shortcuts because we don't really need it that much. 205,000 minus 180,000, and our portion is 40%. That's the portion that we are going to get. Now it doesn't end here as well. There may also be intra-group transactions, or basically usually intra-group transactions are minus, so there's going to be intra-group transactions that should be eliminated that fail within this period. All right, for example, the one where we did a journal. Remember that journal we did was very important. Always also use what you have done already. We did a journal which included the retained earnings. If you remember, we debited retained earnings, and debiting an equity item actually means you're decreasing it, because equity increase on the credit side. So it was this value, and we need the after tax value. So it's 7,200 minus 1944. 7,200 minus 1944. 7,200 minus 1944. Okay, this is where we covered this when we did the journal. Right, so that's basically about it. This is everything we have included. Okay, so let's answer the question. I want to start with the brackets. 205,000 minus 180,000. This multiplied by 40%, plus 70, 850, plus 1,240,000. Okay, then minus, open brackets, 7.2 minus 1944, close bracket. So my opening returned earnings that I'm getting, I think, let me do this again. Let me just do this again. Okay, so let me start with the bracket again. 205,000 minus 180,000. All right, that is 2. You see, I made a mistake again. Ugh, sorry guys, I think there's a problem here. Okay, 205 minus 180,000. All right, 25,000 times 40%, that's 10,000. Then I'm adding these ones. I'm just trying to do them step by step, and not be fast and make a mistake. Plus 70,850 plus 1,240,000. Right, so I'm getting already 1,320,850. Then minus, I open my bracket, 7,200 minus 1944, close. Okay, so this is what I'm getting, 1,315,594. All right, so that's what I'm getting as my opening retained earnings. So I'm going to come to my retained earnings opening balance and put a 1,315,594. Okay, awesome. So this was C. Then the only thing that is left now is the profits. Once we have conquered that and we are sorted. Okay, once we conquer that, we are sorted. So I'm gonna go to D. This one now is calculate profit, consolidated profit. Okay, so let's start. Yeah, this one looks like it's gonna be a long calculation. I'm trying to see how best we can cut this cuts that we can cut. Right, remember we're taking 100% from parents, 100% from subsidiary, and associates we take nothing. We create the share of profit of associate. All right, basically I think that would be the best. So we do the parents, we do the Or alternatively, we can go the routes that we are used to. Let's do the routes we are used to. Revenue. We'll just do revenue, cost of sales, gross profits. Yeah, we'll take it that route is better. It's longer, but it's clearer, especially for explanation purposes. Okay, and then we have other income and other expenses, right? Then we'll have in between here, we're gonna have share of profit of associates. Okay, then we have profit before tax. All right, then we're gonna have our income tax expense. After that, we're gonna have our profit after tax. Okay, right, so we'll rather go these routes. I feel like this route is always safe. It's a very, very safe route. Okay, now the only issue here, which we need to remember very well, is that the group did not we didn't have the group for the whole year because we lost control. Napkins actually only was under the group for 8 months. So if you have to go this approach, we have to remember to apportion that as well. All right, so you can see that it's a lot of work, but anyways, we'll do this. Let's start revenue. So it's not going to be 100% anymore for my subsidiary because the subsidiary we didn't have it for the full year. I'm going to have to apportion my subsidiary items. Right, so revenue for parent is 950, subsidiary 455. Okay, let's pay attention. So this one is 950,000, 455, but remember we didn't have him for the whole year, only for 8 months, ne? So we'll be doing that for everything that concerns the subsidiary this time around. Then we go to cost of sales. Cost of sales, the parent is 425, then 345 for subsidiary. 425, 345. Three 345 times 8, sorry, 345,000 times 8 divided by 12. Then we go to other income. So this is a whole profit calculation. Okay, if you can find a shorter cut, it's fine, but just make sure whatever you're doing, you must not close yourself in your web. Don't close yourself in your own web, né? So don't start something that you get confused with, and then you won't be able to continue. All right. Okay, other income 159. Other income is 159,600 plus this one is 150. Okay, so right, so it's 159,600 plus 150 times 8 over 12. Everything here is going to be a portion 8 over 12. Once we've done that, we go to other expenses. Okay, so this is done. Other expenses, 80 and 45. 80,000 and 45. 80,000 plus 45,000 times 8 over 12. Okay, then lastly, income tax expense. income tax expense. Please, if you're just joining, please like the video, subscribe and share. Right, other expenses. Income tax is 280 and 170. 280,000, 170,000. Okay, so we'll come here. 280,000 plus 170,000. This is times 8/12. Right, so these are every figure that is given. These are all the items that are given. Share of profit of associate, we have to calculate these. The profit was given. I saw it here under NEPIs are us. You see, they did give us the profit was actually 64,000. We're just going to calculate our 40% out of the 64,000. Okay, so we're taking the 64,000, we're calculating our 40%. Remember, the intergroup transaction they had did not affect share of profits. It only affected investment in net investment in associate. So 64 times 40%, that will be a share of profit of associates. All right, and then in other income as well, other income, we have gonna have adjustment in other income, which is gonna be the dividends. The dividends must be eliminated. So I'm gonna go to my analysis and calculate. My analysis is here. Wait, where's my analysis now? Oh, there. Dividend received, this 3,250. Okay, I'm gonna remove this, and also the dividend coming from the associate, that too must be eliminated. Received from the associate. So let's go check how much is their dividends. Dividends is 25. So the associate was 25,000, and I'm taking my 40%. I'm taking my 40%. So I'll just say 25,000 times 40%. All these dividend received must be eliminated. Right, what else do we have that needs to be eliminated? Let's go to the journal that we did, the pro forma journal. So in the pro forma journal, we have all these items that we have to account for. Okay, we have all these items that must be accounted for. Let's not forget the adjustments and their tax as well. So we have here cost of sales. Okay, debit cost of sales means you add, and credit means to minus. So 16,800. I'll start with that. 16,800 on cost of sales. So it's debit, so it's plus 16,800. This is coming from, is it A or not so sure if it's A or B. Then actually it's B. Okay, so we got that. So we dealt with this one. That was also dealt with when we're doing the statement of changes in equity opening balance. Okay, cost of sales done. Revenue 24,000. Revenue is being credited, so it's a minus on revenue. Okay, so it's minus, no, it's a positive, sorry, credited is a positive, so plus 24,000. Revenue plus 24,000 on B. Okay, so that was the last year's stuff. We have to also take the interest the income tax. So we did this done. Income tax, this was also done. Income tax 1944. It's a debit, so you're adding 1944. Debit expense is to add 1944. Coming from calculation B. Okay, that was the one for 2023. Then now the 2024 balances. Okay, the 2024 revenue, we are minusing 12,000. Cost of sales, we are minusing 8.4. So here is minus 12,000. This one is minus 8,400. All right, then the tax. So we're supposed to credit, which is also is minusing an expense. It's 972. 972 minus 972. Right, those are the only intragroup transactions that actually happened between them. We accounted for dividend. We accounted. I think that's everything. I think that's everything. I'm not seeing any other thing. I believe that should be everything that we're accounting for. Right, with that gone, then we are sorted. So let's calculate the total profit, and remember we have to minus the NCI so we can get the parent portion. Right, so I'm closing these are my main brackets. I'm closing my main brackets. Okay, let's start from the revenue. 950,000 plus open brackets 455,000 times 8 divided by 12 close brackets plus 24,000 minus 12,000. Okay, please do the calculation along as well to let me know if the figures are accurate. So it's 1,265,333. Then cost of sales. Cost of sales is 425,000 plus open brackets 345,000 times 8 divided by 12 close brackets plus 16,800 minus 8,400. I'm getting 663,400. If you take this minus that 1,265,333, this will give 601,933. Okay, and then we have other income. Other income 159,600 plus open brackets 150,000 times 8 divided by 12 close bracket minus 3,250 and minus open another bracket 25,000 times 40% close bracket. This is giving me 246,350. Share of profit 64,000 times 40%. This is going to give me 25,600. Right, other expenses. So we didn't have impairment on goodwill. We didn't have that. So yeah, this is it. That is it. It's 80,000 plus 45. Is it 45,000? Yes, 45,000 plus open brackets 45,000 times 8 divided by 12 close brackets. So this is giving 110. Let me just do this. 110,000. This is an expense. So I'll then calculate my profit before tax. 601,933 plus 246,350 plus 25,600. Then minus 110,000. So my profit before tax is 763,883. Right, then we also totalize the income tax. So it's 280,000 plus open bracket 170,000 times 8 divided by 12 close bracket and plus 1949 minus 972. 1949. I just want to double check this 1949. Is it a 49 or 44? 1944. Yeah, thought as much. 44. Okay. Okay, I'll just do the calculation. 280,000 plus open bracket 170,000 times 8 divided by 12 close bracket plus 1944 minus 972, and this is giving me 394,305. Okay, so the profit after tax will then minus this from the profit before tax. So it's giving 369,578. Then remember to less the NCI portion attributable to NCI. Right, the NCI profit, we get that from the analysis of owner's equity that we calculated earlier, or we can get it from the statement of changes in equity. The profit was 10,500. Yeah, 10,500. Okay, so guys, you're just going to double check all the calculations. Just redo all the calculations. The principal is 100% correct. Just redo the calculations, because since I'm adding very fast, I could make mistakes there and there. So 10,500, this is giving me 359,078. 359,078 is what I'm getting as my profit. 359,078. Okay, so we're gonna take that figure there. Profit for the year, there we go. 359,078. So now what we need to do is to add. So we take that figure minus plus 1315594 and minus 70,000. So at the end is 1,604,672. Okay, and then that takes us to the end of our question. That takes us to the end of our question. So now, one thing for sure, even before you are done writing, always go back to make sure you answer the question. Okay, so it's supposed to be consolidated statement of changes in equity. We have done that. Then E was homework. Okay, so guys, that is it. That is everything. That is the full assessment 10 question. Guys, this assessment is very, very important. Like I said, guys, work on those three: assessment 10, assessment 9 last year, and assessment 5 this year. All right, so that was it, guys. Let me bring back my video so we can chat a little before we go, because we are done, finally done. I'm gonna take some questions as well, and I did say that you can bring other questions that you have, which is not other question that is not, maybe it was not covered in the assessment 10, but you have questions that when you were doing questions you came across it. That is also, I'm also taking. Okay, right, so let's see what are our questions. Right, okay, I'm getting a difference 3.5 on statement on the NCI. Okay, so I would have to go to my NCI. Okay, I have to go to my NCI. On the NCI calculation, you said you're getting 3.5. Okay, you said on the statement I'm getting a difference of 3.5 on statement of changes in equity, NCI. Okay, let me go there. Right, now remember now, the values of the NCI are exactly the same values that you had in your analysis of owner's equity. Are you getting the same values? Maybe recheck your analysis of owner's equity, because everything seems fine on my side. On my side, everything seems fine, so I'm not so sure. MK, I'm not so sure where you are getting your difference from. Everything seems perfectly fine on my side, and all these figures are coming from the analysis of owner's equity. So please double check your analysis of owner's equity and let me know. Okay, right, guys, once again, thank you for joining, and like I was saying, I hope this is really going to be beneficial. I hope this is going to be beneficial for you, and this, and I wish you all the best. I wish you all the best for your final chance, your last chance of exam. I wish you all the best. If you do have questions, please post them now. I'm about to end the live recording. If you don't have questions, it's also good. It means you understood everything. Please redo this question on your own. Try to mark yourself again. See how much you understood from the class. See how much you understood. See how much you know by doing it on your own. If you don't do it, you will never really know if you understood it. Because normally what students will tell me is like, Naomi, when we do it in class, it's easy and we understand it. But when you do it alone, we actually understand, we actually figure out that we have issues. So accounting it's a practical module. It's about application. For you to know, to be sure that you know it, you have to sit and do questions. Now, people that do well in accounting are people that have done a lot of questions. Guys, the only formula is to do as many questions as possible. No other formula. Do as many questions as possible, like a lot. Okay, but now there's no time anymore. Do only those three that I'm suggesting: assessment 9, assessment 10 of 2023, and assessment 5 of 2024. Do those only. This time around, you don't have time anymore. Do those three. It should be enough for the exam that you're about to write. Okay, so guys, all the best. Thank you for staying this long. For those of you who have liked the videos, thank you so much. Those of you that have subscribed, I really appreciate you guys. Please stick around. More of these kind of videos will come up. I have also done a lot of videos on accounting topics. Please go and check them out. If you are struggling, especially with groups, I've done a couple of videos on groups. I've done a couple of videos on revenue. Please go and check them out. I've also done a couple of videos on income tax. Go and check them out. Yes, guys, remember, it's not just about writing the test. It's about the world out there. It's about the world out there. And you guys need to make sure you're familiarizing yourself with accounting systems. So I've started up videos on Sage Business Cloud. Please go and watch my videos on Sage Business Cloud. It's gonna help you big time. I even gave you guys a link where you can use the free 30 days trial. You can do that trial 30 days, and it's not automatic. You pay if you want to pay. If you don't want to pay, you don't. So use that 30 days to actually learn Sage. Okay, learn Sage. I'm gonna do more videos on QuickBooks and others. Others I'm going to do research and then also put it out here. So please learn accounting systems. It's not just about this exam, it's about the world out there, and you need to understand systems and all of that is out there. Okay guys, so basically that's from my side. Please guys, please share my links. Please really talk about me, promote the channel. I'll really appreciate you. If you want classes, I am a tutor, guys. I'm a tutor and I have a college, Eureka Tutoring. Eureka Tutoring is my college. If you need classes for anything, just come. Anything, MAC, tax, auditing, FAC. I'm the one teaching the FAC modules, and the AIN modules, I'm the one teaching them as well. And then I have other lecturers that teach the other modules. So please, if you want, you can register with me, Eureka Tutoring. I'm gonna put my details on the description, but much later after this live recording. But guys, thank you so much. Thank you so much. I'll see you guys again next time. Please stick around, and those of you that have just subscribed, please welcome to the family. We appreciate you. Welcome to the family. Here it's about making it. It's about cum laudes. It's about distinctions. Here it's about positivity. Here it's about success. It's all about success. So you're welcome to our family. I love you guys, and enjoy the rest of your evening. Okay guys, bye.